Okay. Hello, Caitlin. This is the first time I've ever tried to record something on my Zoom. But anyways, this is how I'm going to do it. I've done this sheet up. I've only done one question so far. I did this morning, but it wasn't even doing the question. It was kind of doing a way to make it easier to understand. I hope, I really hope, but I've done this one a few times. Everybody hates ratio analysis. I think it's one that you can get marks super easy on. All you got to remember is the formulas. Super important to remember the formulas, and then if they make sense to you at all, then you can write a little about them. I know. Let's see what was the question here. So the liquidity gearing investment, two on each, very easy, and that's just part A. Once you got that, that's literally I think that's like that was like 9 marks. I can't remember. For some reason, I don't have the second part of that sheet. But I think part B says, would you invest in the company? And that's basically asking you, what do the ratios mean? Are they good? Are they bad? And what you do in that one, and I'm guessing you've done it before, is you you see if they're negative or positive to last year. And if they're negative, then that's an X. And if they're positive, and if the positives outweigh the negative, excuse me, the negative, then yeah, then it's good, and it's bad, vice versa. Let's see. Anyways, we'll get into it. First of all, liquidity. So this is how you know how liquid your company is now, and that just means what assets does it have? Does it right now, rather not like loans, not like shares, like what does it have? Does it have like just think of it's all the cash in the bank, all the people that owe the money to them, like they say if they've made sales on credit that they haven't got back, do they have any creditors that they have to pay as well that they have got on credit? So basically, anyways, we'll get into it. The current ratio is the easiest one. So, you got current assets over current liabilities. Don't write it as a percentage. It's 2 to 1, so it'll always be two liabilities. So we'll check it out up here. And this is nice as well. It gives you the current assets. It doesn't break them down. So just this figure to this figure. Ideally, you want a 2 to 1. You want double the amount of assets as to liabilities. And a very easy answer. If it's bad, if it's not, like you're mainly, this is brilliant because you're comparing it to last year. But not only that, you also have like the industry average as well. Screw this. You don't need any of this. That is just bullshit there. But these are the two main ones you got to look at. You got to look at last year's, what they were doing, how they did last year, if they did better or worse than last year, and the average of everyone in the industry. So if negative, I recommend this company should pay more of their creditors back to decrease the level. So this current liabilities is made up of creditors because they're liable. They have to give that money back. If they pay those back, it'll shorten the amount of liability it owes, thus making the liability shorter. Anyways, but like let's look at the how it's doing current asset our current ratio. So 1.82, that's almost the ideal. It's doing worse than last year, but better than the industry average. So it's still doing okay. You want to be beating your competitors. So you could say, yeah, you just say that, and then if it's positive, just say something like something as short as improving ability to pay debt as it falls due. Brilliant. Asset test. Now this one's way better. This one's is just going to be the current assets figure minus its inventory. And the reason why you're getting rid of inventory is because if your bank or your creditors, right, the people that you've bought stuff off, if they go, screw this, you're taking too long. Can I get my money back, please? You're gonna have to pay them right away. So you can't pay them. I always think of Jeff Bezos. Everyone says he's the richest man in the world because he owns Amazon and he owns everything on Amazon. But he really isn't. He's not even close because how much of his money is in stocks, is in every single thing on that website. So that's his inventory. So he's not rich at all, because if it came to a situation where, you know, everyone he owes money to wanted that money back, he'd be screwed because he would have too much inventory and he wouldn't be able to sell it off. The company would be destroyed. So that's why we have the asset test ratio. It means that the current assets minus inventory, because then you're not reliant on inventory. So the company's ability to cover their short-term loans in an emergency situation. It would be an emergency if creditors asked for their money back right away. If this is negative, right? If this isn't one to one, it should be one to one. You should definitely have as much assets as liabilities without inventory. Let's see what we have here. See, this is dangerous now. The company would become illiquid if they're, which is, it's very rare, but if their creditors ask for all that money back, the company wouldn't be able to pay it back. And it's still above the industry average. So you could say that, and it's when it is increasing. So you could say it's positive, but it's still reliant on inventory. So anyways, so you just say, if negative, I recommend that the company should reduce price of product. That means, you're going to have sales. Your inventory is going to go down and your sales will go up. Buy less inventory. Use older inventory before buying more, so that you're using this old stock. You're not buying in anymore. This figure is going down. If positive, you can just say a nice little line like, this company can pay its debts in an emergency situation. How easy is that? Anyways, we're on to gearing. So that's done. Your marks in the bag there. By the way, this is also another thing that I went over, right? I didn't go over. So, if it's good, this is a good trend, because if it's bad, this is a bad trend, because it's just good practice to say stuff like that. If you don't have the time, then don't do it. But it's just nice. It means that you're letting them know that you know exactly if it's good or bad. Gearing ratio. So the gearing is how much the company relies on debt, and that's long-term loans, debentures, whatever. It's not good to rely on the bank to give you all your money. Anyway, so what you're going to do is you're going to put your long-term debt up here above equity, shareholders. This might come in the name like shareholder shares. It might be called shareholder shares. Long-term debt might be loans. If you see loans at all, if you see debentures, that's long-term debt. Okay. Or they have to be long-term bank loans. They'll specify that. But anyways, you put long-term debt over itself plus equity. So these two figures together by 100. And basically, you don't, how much this means how much it relies on the bank, how much it relies on his loans. You do not want to have over 50% of the company's finances as bank loans. More than half of the company's financial finances is in bank loans. This means that if the company, if the bank want their loans back, which they can call back, it means that they own the company, because they have over 50%. They own 50% of the company, so they can take the company off you. You lose everything, right? It's dangerous. Let's see here in what the industry average is. So it's very high. So they're on a tightrope there. We're relatively low. We're going up more, so we've clearly borrowed more money because we've went up, which is bad. We shouldn't be doing that. We should be trying to keep that down. But it's still not as bad as the industry average. It's clearly this must be with the pandemic and everything. Everyone's getting loans, and yeah, that's bad. So you're going to want it. It's important to say, if it's over 50%, say the word highly geared. So that means, just, it's a nice word to say. And if it's under 50%, lowly geared. So that means basically, which I'll show you here, if it's highly geared, companies should issue more shares. They should get more shares. They should try and up this number a bit more to bring that ratio down. So it's a more organic source of finance. You're issuing shares to people who want to buy stakes in the company. They're using their own money. All of them, they're not going to call their money back. They can't do that. It's on their own accord to do that. So it's less risky. if lowly geared, the company is not reliant on loans to survive. Listen, I'm using these keywords here. You could use to to remain in operation, which is a nice corporate term, but I'm just trying to put in the hard hitting words like more organic. Company is not reliant on loans to survive. Means that the company, if this company is under 50% uh, owned by long-term debt, it won't. There's no risk of the banks just going, all right, I'm taking over your company. Interest cover, I hate this one. This one's a boring one. Really not interesting at all. So it's operating profit. Operating profit can also be called profit before interest, and then interest will always be underneath it. So let's look at it here. Operating profit up here. Financial costs. Now that's a tricky way of calling interest. If you're looking for interest, oh, where the fuck is interest? It'll be financial costs. It's just that figure there. And you just divide this figure by that figure, and it's expressed in times. How many times do we cover the interest costs? I didn't, I looked this up. I didn't even put this in because I just don't think it's even worth it. But I'll give it like it's the lower the ratio, the more the company is burdened by its debt, meaning that these loans up here have interest that if they're too much, they're eating into your operating profit. It shouldn't be eaten in. You should be getting at least, 1.5 times. You should be able to pay this twice, 3 times, honestly. If negative, the company, just say a nice little phrase like the company may struggle to cover the interest on their loans in the future. How easy is that? If positive, which it usually is, which it means that it can cover it 3 or 4 times. Let's see how many it covers it 14 times. This company is very, very comfortable. Just say this company can comfortably cover is comfortably covering their loan interest expenses. How easy is that? So just 14 times. Like usually they look at that. So they're covering it loads. Like their competitors aren't doing that well. Now onto these tricky ones. Earning per share is fine. It's this guy. This guy is the bad one. So earning per share is the good one. Price earning is the bad one because you need the earnings per share to even get the price earning. So you start off with this one. So this basically earnings per share is exactly what it sounds like. How much shareholders are earning per share. So the people who've invested in the company want to get their money back, want to make a good investment every single year. They want to get a lot more money back. So it's how much they're getting per share. And that's then if with that logic, you can just think about the profit the company makes divided by the amount of shares. So here's the amount of shares, 6.3 divided by, now this is the tricky part because where's this figure? Where's net profit? So I've it down here. Net profit equals sales minus everything bar dividend, because dividend is what you're giving them, right? So you're going to be taking all these guys here away from him. Forget about him, and then you'll get the net profit figure, which I think is down here. I can actually remember it. It's 79.8. It was 79.8, and then you're dividing it by the number of shares. So that you're just dividing the profit by the amount of shares. If it's better, or what you're doing, if it's positive, there's no ideal, right? The shareholders just want to make more than they did last year, and they did. Look at that. Look at that. The earning per share, they're getting 13 euros. They used to get like 4 euros last year, which was like, and that is almost double the industry average. So they're kicking their competitors' asses, and they're making an improvement from last year. That's a great improvement. I definitely invest in the company if I was making that much money back per share, like considering that was how much it was. So if negative, shareholders are not getting the same return they got in previous years. How easy is that? Just say they're not getting the same money as they got last year. And as a consequence, this is just a bonus, may want to sell off their shares just to want to get out of the company. That's bad. that means that the company is losing their shareholders' equity. Their investment from shareholders gone. They don't want that. If positive, shareholders will be pleased to see that they'll expect a higher return so more dividends. And if they want to sell their shares, they'll be getting a lot more shares or they'll be getting a lot more money for them. So a more expensive share price. So they'll get a lot more money if they even wanted a share. But don't even go into that. Just go into to get a higher return because that's all they want from you. Price earning. This one is so annoying. So the price earning shows what the market the external, so the people who haven't invested in the company, what they would be willing to pay for the share. Is the share valuable? Or is it undervalued or overvalued? I don't know how this works, right? But you express them in time. So you get the share price, which is up here, and you divide it by this figure up here. So you have to get this first. You divide it by that figure, whatever you got. So we got 12.69, and what you want is the lowest possible. The lower, the better on this one. So that's an improvement, but it's nowhere near as good as the competitors. All right. So that just means that it's not being valued. If negative, the market is undervaluing the shares, is what you would say. And I guess if you could say if it's positive, they're overvaluing it. They think it's better than it actually is. It's a very confusing one. But anyways, that's all those done. And then it's pretty obvious as you do it, you'd be like, oh, this shares was great. Let's see, it's improving. All you want to see is improvement, right? Screw the industry average sometimes. Obviously, you can say it, oh, it's better. But if the company's improving, they have potential for the future. So the industry average might not even play a part. So let's go to interest cover. Yeah, it's very comfortable with that. Definitely would. The gearing is a bit high, but it's not half as high as the industry average, so it's still doing well. Acid test. This company could suffer liquidation in an emergency situation, but it's still better than the industry average, and it's improved since last year. So if it's the improvement, if just more and more improvement, right? Screw these ideals, right? All you want to see is improvement. And let's just look at a few figures now. That's the bulk done there. All you have to do is remember these guys, right? But I'll just go through a few little keynotes. Things to look out for. 2019 last year, 2020 this year, the sales. They've went up like almost tripled. They've almost tripled, right? So obviously with the sales almost tripling, the cost of sales have to triple as well. And so will the operating costs. Look at this, financial costs is doing really well. It's not even tripled. It didn't even double. You're just seeing these things. You're seeing it all makes sense. Obviously, with more sales means that you've sold a lot more on credit and there's a lot more people that owe you money. So that's why, things are changing just so you kind of grasp it yourself. As you can see, this is a great thing. Current liabilities have actually went down. That's a good thing. But yeah, no, it's these are like, I don't even know why they gave you these. But anyways, I think there was other questions here. You basically answered both A and B with that question because you're showing them why you would invest in the company. So A, I think B was, would you invest? C was something about benchmarking. Benchmarking just means comparing, right? This is a benchmark. Say you can benchmark against former performances last year. And then the second point would be you can benchmark against the competitor's average. So that means like the industry average, how everyone else is doing. So that's just the two forms of benchmarking you could do. I think that in the third question, it was like, what is this information good for? Who wants to see this information? Easy. Who's the most interested in the company? The shareholders. They're going to want to see if they're making their money back. They're not going to be blindly investing money and seeing their company go to shit. They're going to want to see a good investment, right? Other things employees might want to see. because if their job is at risk of failing, going into liquidation down here, they're going to lose their jobs. So they're going to want to see what's going on. And let's see, another person who would also be interested in the bank. The bank is huge, yeah. They're going to be looking at this and going, oh my God, that's a lot of money they owe us. 64% of their business is what they owe us. We could be taking all that. I don't know, they're like, I don't know, do I want to give them any more loans? We already own 64% of their company. I don't want to give them any more. So the bank will be interested in seeing all these and seeing how the company is doing. So with that, this is one question here. I'll see, can I go through these questions? But this one's definitely the hardest in my opinion. But I think you would just stick to the formulas, getting the formulas done, and then just comparing it to last year. Very, very easy. If it's good, just say a nice little thing, pretend you know exactly what that means. Just write something. But the formulas are going to get you the bag here, I think, 100%. Now, how do I stop